Welcome to Breaking News to Trading Moves.
Good to be here.
We've got a specific, and I mean a really specific, set of numbers to look at, and they're the kind of numbers that are a little hard to wrap your head around.
Yeah, the scale is something else.
The main headline comes from Amazon. They've outlined a capital expenditure plan, a Capex plan, of roughly $200 billion for the year 2026.
And that number, it definitely caught investors off guard. You saw the reaction almost immediately. Amazon's stock sank right after that news broke.
So $200 billion, that's a lot of money. But we need to understand why a spending plan for a couple of years from now is moving the market today. This gets to what you've been calling the Capex shock.
That's the term for it. And the basic idea is pretty simple. Big tech is spending just massive amounts of money.
Right.
We're seeing this collective projection from all the major players of over $600 billion, all related to AI and data centers. And the market is reacting to this by picking winners and losers based on where the money is going and, who's footing the bill.
Okay, so let's stick with those numbers for a second. Amazon is $200 billion, but you're saying the bigger picture is $600 billion.
Correct. The $600 billion is the broader context. That's the collective spend across all of big tech. When you add up what all the hyperscalers are planning, that's the kind of infrastructure build-out we're looking at.
And Wall Street's feeling about this has changed.
It really has. They're becoming much more sensitive to this whole Capex now, profits later idea.
That seems to be the real tension here. The market is basically asking, so when do we actually get paid back for all this?
Exactly. And there are really three things driving that anxiety. The first one is just the risk to their margins. Margin pressure.
Because if you're spending that kind of money, it has to come from somewhere.
Right. More Capex just means lower free cash flow. It points to tighter margins, at least in the near term. So even if your top-line revenue looks good, the profitability metrics, they get squeezed by this level of investment. It's kind of like earning a great salary, but then spending half of it on a huge home renovation. You're building equity, maybe, but your bank account looks a lot lighter day to day.
That's a really good way to put it. And that brings up the second issue, what I call the proof problem.
The proof problem.
Investors are demanding evidence. They want to see that this spending on infrastructure will actually lead to, durable high-margin growth. They're getting worried that it might just result in bigger bills without a big jump in profits to match.
They want to know it's a real asset, not just a growing liability on the books.
Precisely. And the third factor is something we're seeing called leadership narrowing.
Okay.
When you get these mega-cap spending announcements that shock the market, it changes how investors behave. They start rotating out of those crowded AI trades. They move away from the companies doing the spending and start looking for more defensive areas of the market.
So the market is sorting companies into two main buckets, the ones spending the money and the ones getting the money. That's the dynamic. If the hyperscalers are building, they have to buy all the parts and pieces from someone. And those companies are the direct beneficiaries of this $600 billion inflow.
All right, so let's walk through the winners first, the companies that are capitalizing on this spend. Your first category is AI compute and accelerators.
This is the most direct link. I mean, if the hyperscalers have to keep building to compete, then the demand for GPUs and these AI platforms, it just stays strong. We call it pull-through. Even if the market's nervous about the total cost, the hardware companies are still selling the shovels.
And the first name here is, well, pretty obvious, I think, NVIDIA.
Yes, NVIDIA, ticker NVDA. They are absolutely central to the compute side of this. They're the engine.
And who's the second name in that category?
Broadcom, that's ticker AVGO. They're really crucial for all the custom chips and the networking components that have to work alongside the GPUs. You can almost think of it like this. If NVIDIA is the brain, Broadcom provides a lot of the nervous system that connects it all together.
Okay, so that's compute. But you can't just have powerful chips sitting on a shelf. You have to connect them. And that brings us to your second group of winners, data center networking.
This is all about the, let's call it the plumbing of the data center. And to get it, you need to understand a concept called east-west traffic.
Explain that. What is east-west traffic?
Well, in a traditional data center, a lot of the traffic goes north-south. That means it's going from the data center out to the user and then back again.
Right, like when you stream a movie or load a website, the data leaves the building.
Exactly. But with these AI workloads, You have a massive amount of data that's just moving between the servers inside the data center. The chips are constantly talking to each other, training models, sharing data. That internal traffic is east-west.
So the servers are talking to each other way more than they used to.
Substantially more. And that just boosts the demand for high-speed networking, for switches, for optical connections to handle that internal load. If that internal network is slow, your very expensive AI chips are just sitting there waiting.
So who are the players making that happen?
The first one is Arista Networks, ticker ANET. This is their specialty high-speed cloud networking. They make the switches that manage all that internal traffic.
And second?
Marvell Technology. That's ticker MRVL. They provide a lot of the underlying silicon and, importantly, the optical gear that makes this high-speed data movement possible. When you need data to move literally at the speed of light between racks of servers, you need their technology.
So we have the chips, we have the networking to connect them, but these things use a ton of electricity.
They absolutely do. And that leads right into the third category of winners, power and cooling.
This is the real nuts and bolts, the physical infrastructure.
It all comes down to a term called power density. An AI server rack needs so much more electricity than a standard one, and it's just physics. When you use more power, you generate more heat, a lot more heat.
So you need more than just a better air conditioner.
Oh, yeah. You need advanced cooling systems, often liquid cooling now, and you need much more robust electrical equipment to handle that load. This means you're looking at a multi-year build cycle just for the facilities themselves. It's not something you can just swap out.
And who benefits from that build-out?
Vertiv is a key name, ticker VRT. They are heavily focused on the power and cooling infrastructure. They're basically the HVAC and power specialists for these high-density data centers.
And the other one?
Eaton, ticker ETN. They're a huge player in power management. As power density goes up, their equipment, switchgear, transformers, all of that becomes absolutely essential to keep the lights on without, blowing a fuse.
Okay, so those are the winners. The chip makers, the networking companies, and the power and infrastructure guys, they're the ones cashing the checks from this spending.
Yep.
Now we have to look at the other side of this, the losers. Or maybe a better way to put it is the companies that are bearing the cost and the risk.
This is where that Capex shock narrative really hits home. The first category here is, the hyperscalers themselves.
The ones writing the $200 billion checks.
Exactly. The logic here is all about their valuation, their stock multiple. When spending numbers jump this high, the market tends to compress those multiples. Investors get hesitant. They don't want to pay a premium for a stock until they feel confident that the AI monetization is actually keeping up with the spending.
So even if they're great companies, their stock price can get hit just because of this spending anxiety.
Correct. The market starts valuing them more like a capital-heavy utility and less like a capital-light software business. And of course, Amazon is right in this category. Ticker AMZN. They're the ones with the $200 billion headline.
And I assume Microsoft is in that same boat.
Yes, Microsoft, ticker MSFT. They're also spending heavily to build out their AI infrastructure, and they are facing the exact same questions from the market about the return on that investment.
Okay, now, there's a slight difference with the next category you have, the ad-driven platforms.
It's a similar problem, but with a specific lens on their business model. These companies depend on advertising revenue, and they're facing the same heavy AI bills as the hyperscalers.
But the main concern is about the offset, whether the revenue can keep up.
Right. Can their ad business and product sales grow fast enough to offset the higher depreciation and operating costs? That's the question.
And depreciation is a key word there.
It is. These AI chips have a shorter useful life than older servers. You have to replace them much more often. If those costs are rising faster than your ad revenue, that's a direct hit to your margins.
Who are we talking about here?
Alphabet, ticker GOGL. Search is their core business, and running AI against every search is very expensive. Each query costs more to process now.
And on the social media side?
Meta Platforms, ticker META. They are investing a fortune in AI for their recommendation engines and content feeds, and the market is watching that expense line very, very closely to see if it actually leads to better ad performance.
Okay, and there's a third group here that's a bit different. It's not just about spending money. It's about a potential threat to their whole business model. You've called it software and information services.
This is all about the disruption fear. These are companies whose business is providing information, summaries, analysis.
Which is exactly what AI is getting very good at doing.
That's the risk. As these AI tools get better and better at generating summaries and automating workflows, investors start to worry about what they call moat erosion. They
Hmm.
worry that these established companies will lose their pricing power. I mean, if an AI can give you a decent summary for free, why would you keep paying that expensive subscription?
That's a fundamental question for their future. Who are the companies facing that kind of scrutiny?
Thomson Reuters is one, ticker TRI.
Yeah?
They are a staple in the world of information services, but this AI threat is now part of the conversation around their stock. The question is, can they adapt fast enough?
And the other one.
RELX, ticker RELX. They're in a similar information and analytics space, and they're facing that same market sentiment about potential AI disruption. The market is trying to decide if their proprietary data is a strong enough defense against the new AI models.
So we've got a really clear picture of the board now. On one side, you have the hardware, the networking, the power companies. They're seeing immediate revenue because this infrastructure just has to be built.
And on the other side, you've got the platforms writing the checks, dealing with margin anxiety. And then you have these information companies that are dealing with some really basic questions about their future value.
It really does create a split market.
It does. It's a dynamic where this massive spending creates a boom for one part of the market, while at the same time it creates a drag on the very companies that are financing that boom.
The money is just moving from one pocket to another, and the market is trying to figure out which pocket to be in.
That's the trade right now.
We've covered the numbers, Amazon's $200 billion and a wider $600 billion context. We've looked at why the market cares, the pressure on margins, and the need for proof. And we've walked through the specific tickers for the winners: NVIDIA, Broadcom, Arista, Marvell, Vertiv, and Eaton, and losers: Amazon, Microsoft, Alphabet, Meta, Thomson Reuters, and RELX.
And the question that's left hanging over the market is really just about patience.
How so?
The market is asking, how long are investors willing to wait? They need to see that durable high margin growth actually show up. The spending is happening right now. The returns are promised for later. So the question is, how long will they hold on before checking out of the trade completely?
It's a waiting game.
It is. If those margins don't stabilize or if the revenue growth doesn't accelerate enough to justify the spending, investor patience could run out pretty quickly.
That is the key question everyone will be watching. Before we go, I need to read our disclaimer. Please note that this is not financial advice or buy or sell recommendations. This is purely the opinion of the author.
Thanks for listening.
We'll see you next time on Breaking News to Trading Moves.